While many investors have one approach to investing in the market, there are others who say you should use a basket of approaches. Here with us to talk about that is Michael Gayed. Michael, thanks for being with us.
Thank you, my pleasure.
So Michael, you are republishing a book by your father, Michael E.S. Gayed. It is Intermarket Analysis and Investing, Integrating Economic, Fundamental, and Technical Trends. So a lot of people are wondering, well, how might this be applicable to today's market? And I'm thinking about Japan and kind of what we're seeing coming out of there. What would you say?
Well, let's backtrack for a second and talk about what the idea of intermarket analysis is at the core. It's really about integrating multiple schools of thought into a coherent thesis and trying to understand the dynamics and interplay between and across asset classes to identify areas you can take advantage of. Okay, so in other words, how does the movement of stocks affect commodities, currency, bonds? What's the feedback loop that happens across the four major asset classes? Now, the idea that my father was really focused on heavily in the book was really this idea of interest rates and how that is I believe the quote in the book was, it's the heart and soul of the free enterprise system is the cost of money, the interest rate policy. Now, we've been in this environment of significant deflationary pressure since the financial crisis. Central banks around the world have been trying to stimulate through cutting rates. Quantitative easing has been the way to get beyond the zero bound. Now, in Japan, we're seeing massive, massive stimulus from the Bank of Japan through quantitative easing to try to force reflation. Okay, so how does the bond market affect then the Nikkei, the stock side? Well, we've seen this massive rally in the Nikkei, which benefits from rising inflation expectations. Stocks in general tend to do that. The problem that we're seeing now with the Nikkei is not the Nikkei itself, it's bonds. Right? It's the asset class that affects stocks, the intermarket relationship there. In the case of what's going on in Japan, there's this concern that you're going to have some kind of a black swan, massive volatility hiccup, not necessarily in equities, but in bonds, which is what the Bank of Japan is trying to control by printing money, essentially trying to force everybody out of bonds, or at least absorb those assets. Last week, pretty substantial decline in stocks as yields spiked. Now, when my father wrote the book in the 80s, it came out of his own work in calling for the 1987 crash in the United States. The lead up to the 87 crash, behaviorally in terms of intermarket movement, was the stock market was rallying substantially, kind of like what we're seeing with the Nikkei today, and at the same time interest rates were spiking. So you got to somewhere around 9–10% on treasuries in a very quick fashion. So the speed of interest rates combined with the advance of equities caused a massive dislocation. The 87 crash resolved that. I do wonder if we may be seeing some of the inklings of that repeating now in Japan. If JGBs start to collapse, JGBs, which are the treasury equivalent within Japan, interest rates spike in a volatile way. Yes, you can see some kind of major decline in Japanese markets, and I think the implication there could be quite substantial. Part of the thesis of the book is you have to also not just look at your home country, you have to look globally. If the shining example of QE, Japan, starts to falter, and you break this mentality that QE is going to make stocks go up and up and up, and you cannot have a correction, if the biggest extreme of that starts to break, I find it hard to believe that the U.S. will not follow on the downside.
Well, Michael, a final point here for retail investors who are maybe looking for a fresh approach. Why do you think your father's book is one that they should return to?
I think it's too easy to simply look at a moving average or a single trend of a single asset class or a single stock. You have to really understand the dynamics that happen, especially in a world that is so globalized, where everything is interconnected. Nothing is ever really diversified in the sense of one thing moving that does not affect something else. Everything moves in some way, shape, or form with leads and lags. In the case of intermarket analysis investing, the idea really is to try to identify where these trends, where these leads and lags happen, which is really what I reference in most of my writings and media appearances, and try to understand how does something affect something else. If you're too blindsided to just one thing and you miss what's happening on the periphery, you could very easily get hit in your portfolio and miss out on opportunities that could cause you to actually do quite well.